It's 9:32 a.m. on a Tuesday. You check your phone. The stock market is down 2%. By 9:37, it's down 7%. By 9:41, it's chaos. Billions of dollars vanish in minutes. People are yelling on trading floors. Your retirement account just lost a year's worth of gains before you've even finished your coffee. How does this happen? How can a market built by the world's smartest people with the world's fastest computers collapse in the time it takes to tie your shoes? Today, we're pulling back the curtain on the domino effect nobody sees until it's too late. Stock market crashes aren't just headlines. They're not just numbers on a screen. They decide whether companies survive, whether people keep their jobs, whether your savings are safe. And the scariest part? Most crashes don't start with a bang. They start with a whisper, a single trade, a tiny rumor, a flicker of fear. Then, suddenly, the whole system is tumbling down. If you've ever wondered how a trillion-dollar market can break in minutes, you're about to find out. Let's start simple. Imagine a row of dominoes. Each domino is a trader, a fund, a bank, or even a computer algorithm. They're all standing close together, watching each other, waiting for a signal. Now picture this. A big investor decides to sell. Maybe they're nervous about a bad earnings report. Maybe they just want to lock in profits. They hit sell. That's the first domino. But here's the twist. In today's markets, most trading isn't done by humans. It's done by algorithms, machines programmed to react in milliseconds. When the first domino falls, these algorithms notice. They start selling too, faster than any human could blink. Suddenly, prices drop. Other algorithms see the drop and panic. They sell even more. It's a feedback loop. Each sale triggers more sales. Now add another layer, margin calls. Some investors borrow money to buy stocks. When prices fall, their brokers demand more cash. If they can't pay, their stocks are sold automatically. More dominoes fall. And then the circuit breakers. These are supposed to stop the panic. If the market drops too fast, trading pauses for a few minutes. But sometimes that just gives everyone time to panic even more. Here's the uncomfortable math. On a normal day, the New York Stock Exchange handles about 1 billion trades, but during a crash, that number can double or triple in minutes. In 2010, during the infamous flash crash, the market lost nearly $1 trillion in 5 minutes. 5 minutes. And the cause? A single, unusually large sell order, one domino. But the real culprit wasn't the order itself, it was the invisible web of algorithms, leverage, and fear that connected every player in the market, a system designed for speed, not stability. You've probably heard the hype. The market is efficient, diversification protects you, long-term investors don't need to worry. But here's the reality. Efficiency is great until everyone tries to run for the exit at the same time. Diversification helps unless every asset is falling together. And long-term investors, they still have to live through the short-term chaos. The truth is, the market isn't a calm, rational machine. It's a crowded theater with one small exit. When someone yells fire, everyone rushes for the door. So why does this matter? Because these crashes don't just hurt traders, they ripple out to the real world. Companies freeze hiring, banks tighten lending, people lose jobs, homes, and hope. And the irony? The very technology that was supposed to make markets safer, faster computers, smarter algorithms, has made them more fragile. We've built a system that can move mountains in seconds, but sometimes it only takes a pebble to start an avalanche. So next time you see the market drop in minutes, remember, it's not just numbers on a screen. It's a chain reaction set off by invisible hands, moving at the speed of light. The real question isn't how we stop the first domino. It's whether we've built a system where the dominoes are just too close together. And if so, what happens when the next one falls? But let's not stop there. Let's rewind and look at how we got here. Decades ago, stock trading was slow. Orders were written on slips of paper, runners dashed across trading floors, and prices changed at a human pace. If you wanted to buy or sell, you called your broker, who called someone else, who maybe called someone else. It was messy, but it was slow. And slowness, as it turns out, was a kind of safety net. It gave people time to think, to breathe, to reconsider. Now that safety net is gone. Now algorithms scan the market for any sign of weakness. They don't get tired, they don't get scared, but they do get triggered. And when they do, they act instantly. Let's say a company releases disappointing earnings. In the old days, analysts would pore over the numbers, debate the implications, maybe adjust their forecasts. Now, an algorithm reads the report, spots a negative word, and starts selling. Other algorithms notice the price drop and join in. The fall accelerates. Human traders see the red numbers and panic. They sell too. The cycle feeds on itself. It's like a rumor spreading in a crowded room. At first, only a few people hear it, but soon everyone is whispering, then shouting, then running for the exits. And it's not just stocks. The same domino effect can hit bonds, currencies, even commodities. In 2020, oil prices went negative for the first time in history. Negative. Sellers were literally paying buyers to take oil off their hands. Why? Because a cascade of selling, triggered by algorithms and margin calls, pushed prices below zero. It sounds absurd, but it happened, and it happened fast. Let's talk about leverage. Leverage is when you borrow money to invest. It's like playing poker with someone else's chips. If you win, your gains are bigger. If you lose, your losses are bigger too. In good times, leverage makes everyone feel like a genius. In bad times, it turns small problems into disasters. When prices fall, leveraged investors get margin calls. They have to sell, no matter the price. Their selling pushes prices down further, triggering more margin calls for others. It's a vicious cycle. The dominoes fall faster and faster. Now, let's add high-frequency trading to the mix. These are firms that use supercomputers to make thousands of trades per second. They look for tiny price differences and exploit them. In theory, they add liquidity to the market. In practice, they can also pull liquidity away in a crisis. When things get rough, high-frequency traders can disappear in an instant, leaving the market even more fragile. It's like having a lifeguard who's only there when the water is calm. And then there's the role of ETFs, exchange-traded funds. These are baskets of stocks that trade like a single stock. They make investing easy and cheap, but in a crash, they can act like amplifiers. If investors panic and sell their ETF shares, the fund has to sell the underlying stocks. That pushes prices down, which triggers more selling. The feedback loop gets stronger. Let's not forget about the news. In a crisis, headlines move markets. A single tweet, a rumor, or a misinterpreted statement can set off a chain reaction. Algorithms scan news feeds for key words and act instantly. Sometimes they get it wrong. In 2013, a hacked tweet from a major news agency claimed there had been an explosion at the White House. The market dropped 1% in seconds, billions of dollars gone, before anyone realized it was fake. So what's really happening during a crash? It's not just panic. It's a system designed for speed, reacting to every twitch and tremor. It's a network of dominoes, each one connected to the next, each one ready to fall. And the connections are invisible. You can't see them on a chart. You can't measure them with a simple formula, but they're there, waiting. Let's look at a real example, the 1987 crash, known as Black Monday. The market fell 22% in a single day. That's like the Dow dropping 7,000 points today. The cause? A new technology called portfolio insurance. It was supposed to protect investors by selling stocks automatically if prices fell. But when everyone used the same strategy, it made things worse. As prices dropped, computers sold more and more, accelerating the fall. The safety net became a trap.
Fast forward to 2010 and the flash crash. A single large sell order in the futures market triggered a cascade of algorithmic selling. In 5 minutes, the market lost nearly $1 trillion. Some stocks briefly traded for a penny. Others shot up to $100,000. It was chaos. And then, just as quickly, prices snapped back. The whole episode lasted less than half an hour. Regulators spent months trying to figure out what happened. The answer? A complex web of algorithms, feedback loops, and fragile connections. In 2020, the COVID-19 pandemic triggered another crash. Markets fell 30% in a matter of weeks. Circuit breakers were triggered multiple times. The Federal Reserve stepped in with emergency measures. Trillions of dollars were wiped out, then pumped back in. The speed and scale were unprecedented, but the pattern was familiar. A small spark, a rush to the exits, a cascade of selling. So what can we learn from all this? First, markets are more connected and more fragile than ever. Technology has made trading faster, but also riskier. Algorithms don't panic, but they do amplify panic. Leverage turns small problems into big ones, and the